Hello and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archers Daniels Midland. Today's guests are Steve Freed, VP of Grain Research, and Alan Bush, our Senior Financial Economist. And now my first question is for Steve. Steve, if the U.S. government fails to increase the debt limit, how will this affect USDA reports?
Well, depending upon how long we're out, we just wouldn't get any reports like the weekly crop progress reports, the grain inspections, the export sales, and also on October, crop report wouldn't be released. So I think from a market information standpoint, we hope that they raise the debt ceiling. We will get Thursday's USDA's estimate, NAS, of September 1 grain stocks, and also any revision to small grain production. So, but at midnight Thursday, if they haven't raised the debt ceiling, we won't get any reports until they do.
Okay. Are there any updates to harvested yields for corn and soybeans versus farmer expectations?
Well, it's interesting in that I think going into harvest, we thought that everything in the Eastern Corn Belt was going to be record high. On our farm in central Illinois, we're getting really good corn yields, but instead of the 250 that they were hoping for, we're getting 220 and 230. Beans yield looks like they're going to be 65 to 70, but with about 20, let's say 22% of the corn and maybe 15% of the beans harvested as of date, it just feels like the average U.S. corn yield is more like 172 to 174 than the USDA's 176, and that the bean yields might be 1 or 2 bushels below the government's 50.6.
Okay. Now let's move over to Alan. Alan, what will the Federal Reserve Chairman Powell say tomorrow when he speaks on COVID?
Okay, well, I believe that he will say that progress is being made. I think he'll be upbeat on the economy, as central banks often do. In fact, they're almost always upbeat on their economies to one degree or another. So I think that will probably be the case again this time. Also, I believe there will probably be no major surprises, especially since the Fed had just concluded their policy meeting last week. So overall, I have to say the message will be upbeat overall on a variety of topics.
And central banks this year have withdrawn some accommodation in one form or another. Can they continue the pace of reducing easy money policies longer term?
I think that they are on track to be less accommodative. We've had central banks raise rates. We've had central banks reduce quantitative easing. But I think this flies in the face of really what we're seeing with the rate of growth in the global economy. That appears to be slowing. In fact, several banks now have downgraded GDP estimates for upcoming quarters. So I think in the future, especially into next year, the Fed and other central banks will be forced to be slow to remove accommodation. In fact, I would not rule out that possibly by the end of next year that some of these central banks may be reversing some of those tighter credit policies that they have imposed this year and will probably continue to impose this year.
And why did stock indexes advance after the FOMC meeting last week, despite the focus on when the Fed will taper its $120 billion a month in asset purchases?
Well, the consensus view at the time was that the Fed would announce in November details of their tapering program. In fact, the thought was that there would be something specific at last week's FOMC meeting in that regard, and yet there wasn't. The Fed seemed rather vague, saying that there would be more coming, but really no specific details. So in my opinion, the Fed meeting was a bit dovish on balance with that lack of detail. Other analysts believe that it was hawkish since they continue to talk about tapering, but the fact that there were no details as of yet suggests that the tapering might be a bit farther off. When we do get to tapering, it could be in smaller numbers. And in fact, by next year, I think we will see the Fed tapering the taper, so to speak. So with that likely to be the case, stock index futures still seem to be enjoying the easy money policies that are likely to remain for quite some time. And that is an underlying bullish influence for the indices.
All right, Alan. Finally, back to the grains. Steve, could prices rally in October? And should end users add coverage now? And should farmers sell extra bushels?
I think prices are undervalued right now, and I think they will rally a little bit in October once harvest is behind us. I think that in general, end users are short. I don't think everybody has meal coverage, cooking oil or soybean oil coverage, flour coverage after the first of the year. I think China is short soybeans. I think they're short corn. I think they're the biggest short in soybean market that there is. And I think ethanol production also needs to buy corn. And so far, the farmer here in the U.S. has been a reluctant seller, even though harvest is advancing. So as an end user, you should get coverage. For farmers, they've sold already a lot. In many cases, 50 to 60% of the crop that they're harvesting right now. So I think most farmers will wait and see if there is a bounce, either after harvest or going into early next year with La Nina, supposedly keeping U.S. and South America drier than normal. So I think an end user should step up, get coverage now. I think the farmers, since they've sold so much already, they probably should wait for a bounce in prices.
Well, great. Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com.